What's up, everybody? This week, we're going to be talking about something every single American should know about, and that is the tax-deferred 1031 exchange, which allows the wealthiest people in America to make millions of dollars and often pay 0% in capital gains taxes. Now, let me just begin by saying I am not a certified public accountant or tax professional, and all of my videos are made for marketing and entertainment purposes only. So let's start slow here. Everybody knows what income and expenses are, but do you know what the difference between assets and liabilities is? In short, an asset is something you own, and a liability is something you owe to someone else. When you purchase $100 worth of Apple Inc. stock, also known as securities or shares, you now own $100 worth of the company Apple Inc. So when markets determine that what you bought for $100 is now worth $105, you make $5 in capital gains if you sell your stock. So a lot of people sell their stocks for thousands, if not millions of dollars more than what they bought them for. And Uncle Sam is going to want a piece of that profit. So when your employer pays you for work, income taxes are taken out of your paycheck. Maybe you only get 80% of your pay because 20% of your pay is paid in income taxes. If you then go and use $100 of the 80% of the paycheck that you did receive and purchase Apple Inc. stock, and then 6 months later you sell what you bought for $100 for $200, you'll have something called $100 in capital gains. This is separate from your income. And not only do you have to pay taxes on your income, you have to pay separate taxes on your capital gains that you make outside of your job. So now that you understand what capital gains are, let's talk about how you can use real estate to avoid paying any capital gains on the wealth you create in real estate. I would highly recommend, especially if you're watching this under the age of 30, to consider purchasing real estate as an investment, either in addition to or even rather than as a place to live. There are numerous tax benefits to placing your wealth in real estate beyond just the tax-deferred 1031 exchange, which I can of course explain in another video. The 1031 exchange is a swap of one investment property for another, in which you'll either have no tax or limited tax due at the time of the exchange. This section of the US tax code allows you to sell an asset at a profit, could be $100, $1,000, or even $1 million, and defer paying capital gains taxes until a later time. So if you purchase a home at $100,000 and then sell it at $200,000, you would have $100,000 in capital gains that you would owe taxes on. However, if you use a 1031 exchange to purchase another property within 180 days and follow all of the other strict legal requirements, you can defer that payment to a later time. There are a lot of reasons why there is such a large wealth gap in America, but this 1031 exchange is one of the biggest reasons why there is so much generational wealth in this country. Let's think about this for a second. If I purchase a home for $100,000 at age 25 and it increases to $200,000 by the time I'm 35, I can sell it and then use a 1031 exchange to buy maybe another home for, say, $400,000. And if by the time I'm 55, that home has increased to $800,000, I can sell that, use a 1031 exchange, and then maybe buy another home for $1.6 million. And then let's say by the time I die at age 80, that home is worth $2.5 million. So in this example, I bought a home for $100,000 when I was 25 using $20,000 as a down payment, or maybe even less, and then I utilized the power of time and the power of the 1031 exchange to turn that $20,000 down payment into $2.5 million by the time I died at age 80. I mean, let's assume I only paid off half of the last home before I died. So the home's worth $2.5 million, but I still owe $1.25 million to the bank. So my total net worth is half of $2.5 million, or $1.25 million. So here's the key to generational wealth. My heirs get something called a stepped up basis when I die, which essentially means the $2.4 million in capital gains that I've been deferring for 60 years through 1031 exchanges actually dies with me. So my children will now have $1.25 million worth of wealth built up in this example that they can sell and pay $0 in capital gains. Now I want you to imagine how much wealth their kids would have if they followed a similar strategy and then died and then passed it to their kids. Compound that for generations and generations, you can see why there's such a huge wealth cap in this country. A lot of people's rich kids aren't paying any capital gains on their parents' wealth. This is insane. And what's even crazier is that you can do this. So a 1031 exchange is a swap of one investment property for another investment property that is considered like kind in the eyes of the IRS. There is no limit to how many times you can do this, and under some circumstances, this can even be done to your personal home. But this provision was designed for investment properties. So, you must swap the property for a like-kind property. The IRS defines this as any property held for investment, trade, or business purposes. So the definition is relatively loose, but the two properties must be used for the same purpose. I would spend some more time looking into this if you want to be sure of when you're going to do it with your own personal home before you move forward on anything serious. But since it's very unlikely that you'll find a like-kind property that you can exchange with yours day of sale, most of these transactions will fall under the delayed exchange procedure. So under these circumstances, you will have 45 days to choose a designated replacement property. In this time, an intermediary approved by the IRS will hold the proceeds, aka cash, from the property you just sold that you want to exchange so that you do not receive the cash in hand and instead only use it to purchase the new exchange property. Now, since it can take a long time to purchase a new home, and since deals fall through, the IRS will actually allow you to designate up to 3 properties in this time frame as long as you eventually close on one of them. The second rule of timing on a delayed exchange is that you have exactly 180 days from the sale of your previous property to close on the next one. This gives you 6 months to buy a home and qualify for the 1031 exchange. So there are a lot more details involved in a 1031 exchange, so I highly recommend you consult a tax professional before moving forward with any hardcore plans. But I wanted this video to serve as an introduction to anyone who didn't know about this powerful provision in our tax code. And as always, thank you guys so much for watching. If you like this video, please let me know by hitting that like button and leave me a comment telling me what you think about the crazy opportunities presented through real estate. I love you guys. It's always a pleasure. And as always, I'll see you next week. Peace out.